Welcome to the Kalkine Media Educational Series. Today we'll talk about types of life insurance offered by super funds. I'm Holly Shields and let me take you through this topic. Life insurance is something that everyone needs, especially the ones who have dependents. Also, an ideal situation for opting death benefit, total and permanent disability or TPD, income protection and trauma insurance. However, this type of assorted comprehensive insurance cover can burn a hole in the pocket and may cost as high as thousands of dollars per year. Clearly, affording this is not everyone's cup of tea. Hence, mostly people need to be selective about the insurance cover and even compromise on a few things. The majority of people opt for death benefit insurance, but even that is not cheap. This is why more and more people go for the default death benefit cover offered by the superannuation fund, which is way more pocket-friendly. The reason for this lies in an interesting fact that superannuation funds buy policies in bulk and get discounts from the insurance companies. Also, super fund insurance payments can be done with pre-tax dollars, but if one buys insurance outside the super fund, he has to use after-tax dollars. Super funds usually provide three kinds of insurance for their members. Firstly, life cover, also known as the death cover. This cover pays a lump sum or income stream to the policy holder's beneficiary in case he dies or has a terminal illness. TPD insurance. This one gives a benefit if one becomes seriously disabled and is unable to work again. Income protection insurance, also known as salary continuance cover. This one provides with a regular income a specific span of time if the policyholder is unable to work due to any disability. The majority of super funds already come along with life cover and TPD insurance. While a few others offer income protection insurance, this insurance comes with a specific amount and is commonly available without medical checks. Super funds can cancel insurance too. As per the law, super funds can cancel insurance on idle super accounts that have not received premiums for at least 16 months. To add to this, super funds might have their own regulations and operating mode. The point is that the balance in super account should not be too low. In general cases, the super fund contacts the individual if the insurance is about to end. The policyholder might want to retain the insurance if he does not have any other insurance, if he has a particular need for it, or basically has dependents. Insurance will not be provided if the candidate is a new super fund member less than 25 years of age. One needs to write to the fund to request insurance through the super, and if you work in a dangerous high-risk job, one can cancel the cover if not required. When it comes to the advantages and disadvantages of life insurance through super funds, the advantages are the premiums of a life insurance policy via super funds are comparatively lesser because the super fund buys insurance policies in bulk. Then the insurance premiums are automatically deducted from the super balance and are easy to pay. Also, most of the super funds will, by default, accept that the holder already goes through regular health checks. This can be useful if the cover holder works in dangerous circumstances or has health conditions that can make it difficult to get insurance outside super. Then the policyholder can increase the amount of cover he has above the default level. But this generally involves a few questions about medical history. Paying for an insurance under super fund is quite tax effective too. Premiums of the insurance under super fund and salary sacrifice contributions are taxed at 15%. This is lower than the marginal tax rate for most people. When it comes to disadvantages, a TPD insurance cover in super fund generally ends at the age of 65. Life cover ends at 70. Whereas outside super fund, any cover continues till the holder is submitting premiums. Secondly, the amount of cover the policy can get via super fund is generally lower than the cover one gets outside of super. If one changes super funds, or the contributions stop, or the super account becomes inactive, the cover may end and the holder could end up with no insurance. Next, premiums of the insurance are deducted from the super balance. This lowers the savings for retirement. It is quite significant that one has an insurance with superannuation fund to increase the super premiums to cover the cost of the insurance. If the policyholder is unable to decipher what the policy has on offer, he or she can contact their insurer or fund or financial advisor. Also, one must learn what the benefits of the fund provide the policyholder retires. Opting for insurance through super can be a good strategy to lower the cost. The key is getting the balance right. Well, that was all about types of life insurance offered by super funds. Thanks for watching Kalkine TV, and stay apprised and invest wise with Kalkine.